Welcome everyone! Is green energy still the future of investing, or has the hype faded into the past? Picture this: vast solar farms glistening under the sun, towering wind turbines slicing through the air, and cutting-edge hydrogen fuel cells powering the next industrial revolution. These images have dominated headlines for years, promising a clean energy future. But as we look ahead to 2026, the big question looms. Are these renewable energy stocks still worth your investment dollars? Today, we're diving deep into the sector to uncover the truth, exploring whether solar, wind, or hydrogen can deliver returns amidst shifting market cycles and policy landscapes. Stay tuned as we break down the numbers, assess the risks, and highlight the opportunities that could shape your portfolio. The renewable energy market has captured the imagination of investors worldwide, and it's easy to see why. Industry experts project that this sector could soar to a valuation of $2 trillion by 2030, a figure driven by an insatiable global appetite for sustainable power. This growth isn't just a fleeting trend, it's rooted in real-world needs. Rising energy costs have pushed households and businesses to seek alternatives to traditional fossil fuels, which have become increasingly expensive and environmentally taxing. At the same time, international commitments to achieve net zero emissions by 2050 have spurred governments to pour billions into renewable infrastructure. In recent years, subsidies, tax credits, and renewable energy mandates have created a fertile ground for companies in this space. But here's the catch: the renewable energy landscape is far from static. Market cycles can turn quickly, and policy shifts such as changes in government incentives or the introduction of tariffs could alter the trajectory overnight. So, is now the time to jump in, or should you wait for the dust to settle? Let's dig into the details to find out. To understand where we stand, let's start with a broad market overview. The drivers behind renewable energy's rise are powerful and multifaceted. The global push for net zero emissions is perhaps the most significant force. Countries across Europe, North America, and Asia have set ambitious targets, committing to phase out coal and oil in favor of cleaner alternatives. This has led to a surge in public and private investment, with billions flowing into solar farms, wind projects, and hydrogen research. Another key driver is the escalating cost of traditional energy. As oil prices fluctuate and natural gas supplies tighten, renewable sources like solar and wind offer a more predictable cost structure over time. Government support amplifies this effect. Subsidies for solar panel installations or tax breaks for wind farm operators have lowered the barrier to entry for many companies. Yet, the sector faces challenges that can't be ignored. Market cycles often bring volatility, and renewable energy is no exception. A sudden rise in interest rates could dampen investor enthusiasm, while oversupply in certain markets might depress prices. Policy risks are equally critical. A government might reduce subsidies to balance budgets, or impose tariffs on imported solar panels, impacting profitability. These factors create a complex picture, but they also open doors for savvy investors who can navigate the terrain. Now, let's zero in on some specific companies that stand out in this evolving landscape. To keep things grounded, we'll focus on firms with tangible assets, physical infrastructure or proven technologies, and stable cash flows, steering clear of speculative ventures that promise the moon but deliver little. Our first pick is First Solar, a heavyweight in the solar panel manufacturing industry, trading under the ticker FSLR. This company isn't just riding the wave, it's helping to create it. First Solar designs and produces high-efficiency solar modules, which are used in utility-scale projects across the United States, Canada, and Europe. Their manufacturing facilities are state-of-the-art, giving them a competitive edge in production capacity. In the past few years, they've reported a robust 20% compound annual growth rate in revenue, reaching $4.5 billion in the latest fiscal year. This growth is fueled by a surge in demand for solar installations, particularly from utility companies looking to meet renewable energy quotas. Their price-to-earnings ratio hovers around 22, which is attractive for a company with a project backlog exceeding $10 billion. This backlog represents long-term contracts, providing a steady revenue stream that insulates them from short-term market dips. What makes First Solar particularly compelling is their focus on innovation, developing thinner, more efficient panels that reduce costs and improve performance, positioning them as a leader in the solar race. Our second company is Vestas Wind Systems, ticker VWS, a global giant in wind energy with a strong presence in Europe and expanding markets in Asia and the Americas. Vestas doesn't just build wind turbines, they design, install, and maintain them, creating a full-service model that ensures recurring revenue. Their 2025 financials show an 18% year-over-year revenue increase, pushing their total to $16.7 billion, driven by new offshore wind projects and service contracts. Their price-to-earnings ratio stands at 25, reflecting a premium for their established market position and technological advancements, such as larger, more efficient turbine blades. Vestas boasts a portfolio of over 150 gigawatts of installed capacity worldwide, a tangible asset base that underpins their stability. They've also diversified into energy storage solutions, pairing wind farms with battery systems to provide consistent consistent power, which is a smart move as grids modernize. For our third pick, let's turn to Ballard Power System, ticker BLDP, a pioneer in hydrogen fuel cell technology. Hydrogen is often hailed as the next frontier in clean energy, with potential applications in transportation, industry, and power generation. Ballard focuses on developing proton exchange membrane fuel cells, which convert hydrogen into electricity with zero emissions. Their 2025 revenue grew by 12% to $180 million, supported by partnerships with bus manufacturers and industrial clients. Their PE ratio is higher, around 40, due to the early-stage nature of the hydrogen market. But they've secured contracts worth over $1 billion, including projects to deploy fuel cells in heavy-duty trucks. Ballard's strength lies in their production facilities and intellectual property, giving them a foothold as hydrogen infrastructure expands. These three companies, First Solar, Vestas, and Ballard, offer a cross-section of the renewable energy sector, each with real assets and a track record of cash flow. Of course, no investment is without risks, and renewable energy comes with its share of challenges. Let's break those down. One of the biggest concerns is policy volatility. Governments can be fickle. Subsidies that prop up solar or wind projects one year might be slashed the next to address budget deficits. For example, a sudden tariff on imported solar panels could raise costs for First Solar, eating into their margin. Commodity prices add another layer of uncertainty. Lithium, a key component in energy storage batteries, often paired with wind and solar, saw a 30% price spike in 2025 due to supply chain disruptions. This affects manufacturers and could lead to higher production costs. Market cycles pose a third risk. If interest rates climb to combat inflation, investors might pull back from growth stocks like these, favoring safer assets like bonds. The renewable energy sector has seen its share of booms and busts. Remember the solar stock crash of 2012? And 2026 could bring similar turbulence if economic conditions shift. These risks demand caution, but they don't tell the whole story. On the flip side, the opportunities in renewable energy are substantial, especially for those with a long-term horizon. The sector's growth is tied to unstoppable global trends. Net zero commitments mean that governments and corporations will keep investing, creating a demand pull that's hard to resist. Emerging markets, particularly in Africa and Southeast Asia, are industrializing rapidly, and their energy needs will lean heavily on renewables due to limited fossil fuel reserves. Population growth, projected to exceed 9 billion by 2050, will only amplify this demand. For investors, this translates to potential for stable returns. Let's take a closer look at that with a simple chart. Imagine a split screen. On one side, the S&P 500 shows a steady upward trend over the past 2 years, gaining 10%. On the other, a renewable energy index, including stocks like First Solar and Vestas, has climbed 22%, outpacing the broader market. This performance gap highlights the sector's resilience and growth potential, even amidst volatility. Companies with strong balance sheets and diversified revenue streams are best positioned to capitalize, offering a hedge against economic downturn while delivering solid gains. Comparing these, First Solar's $10 billion contracts ensure stability. Vestas' service model adds steady revenue, and Ballard's hydrogen offers high risk-reward potential. PE ratios 22, 25, 40, and a revenue growth 20%, 18%, 12% suit varied risks. The boom matures. First Solar and Vestas offer stability. Ballard risks growth. Focus on fundamental. Long-term demand holds. Check reports. Risks like policy shifts apply. Research or consult an advisor. Like, subscribe, comment, green energy or other sectors. See you next time.